Hi guys, in this video I'm going to cover the content of BTEC Level 3, Unit 3, the Statement of Comprehensive Income, which is part of Business Finance. What is the Statement of Comprehensive Income? The Statement of Comprehensive Income calculates whether the business has made a loss or a profit by taking the expenses away from sales revenue. If the Statement of Comprehensive Income is made correctly, it will give you a calculation on how much profit or how much loss a business has made over a period of time. The Statement of Comprehensive Income can also be known as the income statement. The first part of the Statement of Comprehensive Income. The first part of the Statement of Comprehensive Income is made up of three parts. The first one is sales revenue. So this is the amount of money that is coming into the business from them providing a good or a service. Now the way that this can be calculated is you do the quantity sold times by the selling price. The second part is cost of goods sold. So this includes the cost of providing the good or service. So to work out the cost of goods sold, you do the opening inventory plus the purchases minus the closing inventory. What is opening inventory? Opening inventory is the value of the inventory at the start of the financial year, and closing inventory is the value of the inventory at the end of the financial year. The third part is gross profit. Now, gross profit is the amount of money that is left after the cost of goods sold has been taken away from the sales revenue. This is not the business's final profit, as there are other expenses that still need to be deducted. To work out gross profit, you would do sales revenue minus the cost of goods sold. For example, here are the sales of a business. Now, to work out the cost of goods sold, we would do the opening inventory plus the purchases minus the closing inventory. That's going to give us the cost of goods sold value. To work out the gross profit, you do sales revenue minus the cost of goods sold, and that's going to give us the gross profit. Calculation of profit or loss for the year. Profit is the money after all the expenses has been deducted off and any other revenue income has been added. Revenue income is income that the business receives from any other sources other than sales that they make. For example, discount received. Depreciation occurs as an expense in the Statement of Comprehensive Income. This will help accountants spread the cost of their asset over the asset's lifetime. To calculate profit of the year, you will do gross profit minus the expenses plus any other revenue income. Profit before tax and profit after tax. Profit before tax is a profit that the business will have before any tax is deducted off. Now, profit after tax. Tax must be deducted off from the profit. This is the percentage of the profit that's going to be given to the government. After that has been deducted off, the business can then decide how they can use the profit. Usually, businesses will just put that money back into the business. Now, the profit that profit is known as retained profit. Retained profit is a profit that's going to be transferred from the Statement of Comprehensive Income to the Statement of Financial Position, which is known as the balance sheet. What is depreciation? So depreciation is an accountancy concept and is used to spread the cost of an asset over its useful life. So when a fixed asset is shown in the Statement of Financial Position, it must be given a value. Therefore, the fixed asset is depreciated on an annual basis, and the amount that the asset is depreciated by is shown as an expense on the Statement of Comprehensive Income. For example, if a company bought a machine for £20,000 and 4 years later they still said that the value of the asset is £20,000, that's going to be unrealistic. The Statement of Financial Position should show the historic cost of the asset, which is the cost of the asset when they first purchased it, and the amount it has been depreciated by, and the current value. The final figure will be known as the net book value, so how much the asset is worth at that current time. There are two methods to depreciation. The first one is straight line depreciation. Straight line depreciation is when an asset is depreciated by a set amount each year. This method involves reducing the value of the asset from the price that the business paid, which is the fixed amount, and two pieces of information is needed to calculate it. One, how long the asset is expected to stay in the business, so its expected life, and how much the asset might be worth at the end of its useful life when it's sold, which is the residual value. The formula used is historic value minus the residual value divided by the expected. Here's an example. If a van were to cost £14,000, the business are expecting to use that van for 3 years and the resale value is £5,000. So the formula would be historic value minus the residual value divided by the expected life. So we do £14,000 minus £5,000 divided by 3. That's going to be £3,000 per year. So the £3,000 is going to be an expense in the statement of comprehensive income. The second method is reducing balance method. This method involves reducing the value of the asset by a set percentage. The percentage will be decided by an accountant and this will be stated in the financial reports. This method will depreciate the asset by a lower amount as the asset will age. For example, if a van were to cost £14,000 and it was depreciated by 20% per year, this is how it will be calculated. The year 1 depreciation would be £14,000 times 20%, which would equal £2,800. And the net book value for year 1 would be £14,000 minus the £2,800, which will be £11,200, and do that for each year. Prepayments and accruals. It is very important the financial records are accurate. On the statement of comprehensive income, expenditure that is shown must match the period in which the good or service is used. So if a business were to pay rent in advance, the expense might have happened in that year, but the good or service will not be used until the next year. So in order to take that into account, 2 adjustments must be made to the statement of comprehensive income. 1, accruals. So this is when the revenue or the expense is recorded when the transaction occurs, rather than when the payment is paid or received. This will be a current liability in the statement of financial position, and this will be an expense in the statement of comprehensive income. Prepayment. This is when the payment is made before the good is received. This will be taken out of the expense in the comprehensive income and will be a current asset in the statement of financial position. Interpretation, analysis, and evaluation of the statements. Once the statement of comprehensive income is produced, it can be used internally for the management to make decisions, and it can be used externally by investors and creditors. It can be used to compare figures in the statement of comprehensive income. It can be used to compare between years. It can be used to see how different parts of the business is performing, see how the business is performing in relation to their competitors. It's useful to consider profit quality. Profit quality shows how sustainable the profit is. It's important to make sure that the profit is increasing due to the business's sales and not because of one-off events. And the profit quality is also used to see how accurate the information is. Now, you can pause the video and try out some practice questions to test your knowledge. If you like this video, then give it a like, subscribe to see more. You can follow my Instagram to check regular updates on resources and YouTube videos, and there's also resources available to this video on my test shop.